and welcome to Property Question Time. I'm Stephen Galpin, and this is the show where you can have your property related questions answered by our team of property experts. And joining me today is Zee Razaq, CEO of Surtax Accountant Limited, property taxation specialist. Welcome to you, Zee.
Thanks for having me, Stephen.
Good. And James Hadley, founder of Property from Pensions, pension tax specialist. I think your second show, James.
It is. Thanks for having me back.
Good. Okay. Well, I'm sure you'll give us the super answers that we want to these questions. And Zee, you're going first. I own 100% shareholding in a small property company which holds and benefits from about 6 buy-to-let properties. My eldest son is now 21 and I wish to give him a 50% share of the company and make him a working director. This is with the idea of growing the company and securing his future. Will he suffer any penal tax charges if I do this? And if so, is there a more tax efficient way of achieving my aim?
Yeah, well, great question, and we'll try to cover it in a summarised way over 2 parts. First part is what's the implications if I just pass the shares over to my son? The problem is you get potentially hit by 3 taxes. 1, depending if I pay anything, stamp duty, land tax on shares, capital gains tax, and potentially inheritance tax if I gift it. The big one out of those 3 is capital gains tax, because what happens with property investment companies, you can't defer it, where you can do with trading businesses. And this is the big challenge. The normal way people do this is get a property tax specialist involved, and they set up something called a family investment company. And what people do is they split up the shareholding between, say, growth shares, and the current value of the shares. So basically what you're doing is that the existing value you're putting into the shares that are currently there, and then future growth you're putting it in for the children. And they normally whack that into something called a discretionary trust. And there's a reason why, because you mentioned he's 21. He's not got married yet. And if he is intended to get married, that could cause some problems. And if you don't put it in a discretionary trust, then there's a right for his future wife, if something goes wrong, to make a claim on that. So
this division of shares and allocation of shares, that works then from an existing company?
Yes.
Okay.
Yeah, so the part of the journey is key. This is an ongoing, it's already happened. You would do it at the beginning, and therefore you can take everything out of inheritance tax, and there would be no capital gains. But if it's a ongoing concern, the problem is you've already got value ready in there, you've already had a gain from when you bought the property to now. You can't just pass the shares over like you can in a trading business and claim gift relief.
Okay.
That's the big difference. So you have to get that planning, get the advice, and understand the future legacy, because this is what I call legacy planning. So if you want to give them dividends and ownership, there's a smart way of doing this. Normally what happens is, say the husband or the wife or the father and mother, what they normally do is they control the actual rights of running the business, and they pass future ownership rights to the children from that, and they call it freezer values. The shares freezered, the existing shareholding, and the new shareholding is then growth shares. Okay. So you get around future inheritance tax.
Well, you're spot on with that sort of analysis, really, because I mean he's very clear in his question. He says that, you know, he's doing it for the future, isn't he? That's really what it's all about.
I think there's one more issue that you just got to think about is the existing gain. So if you've done it 2-3 years, you've had a ready gain. So you've got to attack that as well. So we've got to split the existing gain and the future gain. So that strategy sorts the future gain. You've got to do different things to try to attack the existing gain, because for inheritance tax, it's whatever the asset value is less any financing costs, which opens opportunities to manage the existing gain as well.
So what seemed a nice simple idea, it's going to take a day or 2 to sort out, is it?
Well, potentially longer, but getting good advice and understanding what the long-term goals are so important. I know I keep on going about this, but really understand what they're trying to achieve, why they're trying to achieve, and making sure they know the options. I think that's key.
Okay. Zee, do you find that people typically leave succession planning a little bit too late?
Absolutely, and this is one of the biggest areas, right? Because they don't understand the implications. Because when they started, they didn't know how big it was going to scale. They probably didn't even get the right advice, and then suddenly they're like, "Oh, I've just got what's this capital gains? What's the inheritance tax?" And sometimes they get both, because if you haven't paid the cash, you get the capital gains tax because it's a deemed disposal. technical word, when you don't pay money for it, but it's still part of your estate. So for 7 years, you're going to get hit with inheritance tax.
Yeah, so potential for double taxation.
And this is the biggest problem. And it's that differentiating, getting advice from someone who understands investments compared to trading business. And unfortunately, your general mill accountant won't probably know this kind of stuff because they've got to specialise in this area.
So our tax experts are agreed on this, are we?
I think so.
Good. Okay, well done. That's a good, clear answer. James, your question. I would like to invest in a residential property, but I do not have a lot of available cash to do so. I do have a reasonably sized pension, but it appears from the research that I've done, it isn't possible to invest in property through my pension that's already set up. Is this correct, or are there ways to do this?
Oh, absolutely. And I think there's an awful lot of people that are already invested into residential property and they just don't realise it. For an awful lot of people that have got managed funds within their pension scheme, they'll be exposed to the FTSE 100. Within the FTSE 100, you've got large residential developers. You've also got real estate investment trusts that hold residential property. So even if people haven't made a conscious decision to access that asset class, they are still exposed. So then they've got to consider whether actually, if they want to get further exposure to it, how they do that. Now, you could transfer to a self-invested type of pension that could hold commercial property directly, but if you were to hold residential property directly, there are some pretty nasty tax charges that would be due.
So what's the logic behind that from the government's point of view?
Well, I think that in terms of how they've written the legislation, it's actually to stop people using tax relief money to buy fancy residences or second homes, in Saint-Tropez.
In case of self-use.
Yeah, absolutely. But there are some very clear exemptions in the legislation that cover when investment into residential property is allowable and exempt from tax charges. And so essentially what the legislation dictates is that the pension scheme has to have a specialist holding structure for the property. If that holding structure qualifies for an exemption, it can then hold residential property on behalf of the pension scheme.
And what's the criteria for getting that exemption?
Well, HMRC have got to deem that vehicle, the holding structure, to be what they call a genuinely diverse commercial vehicle. It's a bit of a mouthful, but GDCVs are a very specialist area. But one of them we've already just mentioned in passing here. Real estate investment trusts are genuinely diverse commercial vehicles, as are trading concerns, large listed house builders, and there are a couple of other varieties of structure that qualify as well.
Okay, all right, okay. Well, sounds quite complex, but nevertheless, to answer the question, it is possible.
Oh, absolutely. And for anyone that's struggling to sleep at night, they can go to paragraph 20 of Schedule 29A, Finance Act 2004, and do all the reading themselves.
I'll have a quick look before I go to sleep tonight, just to
better for you than Valium, I'm sure.
Yeah. Zee, anything to add to this?
There's so many different ways of it. I sort of look at it slightly differently because it depends on how much the person's value is, what their wealth is, and where they are in the stage. Because what James is mentioning is probably for people who've got either longer term ideas and have a bigger scale because they have more investment funds and therefore have to invest in a product to provide that. You can have a SAS pension, small self-administered scheme, and do a loan back, right? So you've got 500,000 in your pension. You can loan 50% to a limited company, which is an SPV, special purpose vehicle, which can hold property, fancy name, and you loan back 50%, and you can then buy property residential in the limited company. So you can indirectly use those funds. Generally, the rules are if you have a SAS and things like this, most residential, depending if it falls under one of the exemptions or not, you can't hold it directly in the SAS. So you can do it in different ways. And there's also few tax benefits of doing that, because when you do the loan, you can charge interest, right? So you reduce corporation tax, that saving goes then against your corporation, and that money then goes into your pension, and there's no income tax.
But one of the things that you have to be very careful in taking that sort of route is the security for the loan.
Of course.
Because the big barrier to a lot of people lending to a limited company is there isn't actually security in place at the point that the loan is made. So what we see an awful lot of is uncompliant loans where people have lent money to a company and then they've bought a property and put the security in place afterwards. That actually creates an indirect investment.
So would revenue treat that a little bit like the way they would treat you if you sort of borrowed money from your company and you've got to pay some advanced tax?
But it's a time bomb. It's a ticking time bomb.
Yeah.
And at the moment, it's one of those things that seems to be largely it doesn't have a lot of attention from the revenue at the moment, but I think they're waiting until such a time as it does, and there's going to be some fun and games.
I think James raised a fantastic point about that. The security is so important, but there's a few different ways of doing security. So what we're talking about is unencumbered property. So you can have property, if it has no mortgage, that you can use as a security. And James is right, that some challenges. Another way is if you've got a trading business, the shares are also considered property. So provided you've got accounting valuation done on your value of your company, you can use that as a security as well. So there's a few different ways, provided it meets the criteria, to do this. So this is where you need people like James and myself who actually understand the implications of this and to use it properly.
Okay. Well, on that happy note, I think we'll go to the break. That'll give us a little bit of time to absorb all this rather technical information we've been given. Join me again after the break when we ask Zee and James more of your questions. Hi and welcome back to part 2 of Property Question Time, and we're here with Zee Razaq and James Hadley answering your questions of today. So Zee, your second question. I have a number of properties which comprise of a mixture of commercial and residential properties. They are held in a number of limited companies. If I suffer rent losses through non-payment of rent, basically because of the economic climate, is there any way my losses in one company can be set off against profit in another, given that I'm the sole shareholder and sole director in each case?
So it's a bit of a trick question, this one. The reason being is a piece of information missing is whether these companies are in a group structure or not. And
it sounds like not.
And if they're not, then you need to make them into a group structure, because the only way you can offset losses is provided the parent company holds at least 75% shareholding, and then you can offset them within the group, provided it was part of a group at the time when the losses occurred. So there's special rules around that, but then yes, you can benefit. But if you've incurred the losses, unfortunately, you're going to have to carry forward against that company's future profits.
Okay. And if you did have those limited companies in a group situation, would they all have to have a similar purpose? Would they have to be, their mem and arts have to be sort of similar?
Good question, no. Provided the group company, the holding company, owns 75% shareholding.
In each one?
Yes, and it's owned through that time, at the same time, because the reason being some people put it right near the year end and then it's prorated. So if I've got, say, a 31st March year end and I suddenly made this part of group on 1st of March, I can't claim the whole year in there, so it's prorated. So that's the key benefit, is making sure that you've got these structured and then you can use these losses.
I was just going to say, again, it comes back to getting the structure right at the beginning, doesn't it, as you grow. Yeah. Have you got anything to add to that, James?
Yeah, I think you've just touched on the point perfectly there, Stephen, is that actually trying to retrofit these things once you've got the problem, that's where things become costly, or sometimes a lot of the options that you would have had at outset suddenly are out the window.
Very difficult. Again, it just underlines the need for professional help these days, doesn't it? So life is really quite complicated, isn't it, at the moment?
It depends on who you've got supporting you. I always say to people, get a good power team in place. If you get a good power team and the people are confident in the area that you're dealing in, then you don't have to worry, because that's why you have professional advisors part of your team, so you can speak to them and they give you what implications are, give you ideas of how to manage these implications, and also help you make more money, and that's what the name of the game is.
Can I just clarify, if you set up this group structure, let's say you've got half a dozen companies and they're all 75% owned by the top group company, is there any restriction on the ownership of that top company? Does that have to be split, or can that be with the same individual?
It depends on when you do it. So if I did it at the beginning, it doesn't really matter how I have that. But if I do it, it's an ongoing concern, and suddenly now I want to import a parent company in, then we have to ask HMRC for a clearance process, and you're exchanging your shares in the parent company. Yeah. That's what you're doing. So it has to be like for like.
I guess the essence of the question is, he's saying, well, look, I own everything anyway. Does it make any difference? And
not if you have 100% shareholding, but what I found is some people think, right, I've got 100% shareholding now, but in my parent company, I might have someone else on there as well. Then HMRC are going to say, hold on, there's a stamp duty implication and potentially a capital gains tax implication, because you have to have it for stamp duty mirroring the ownership, because that's why you're getting clearance, because what you're doing is you're exchanging your shares in your current company with the parent company, and the ownership has to match.
And I suppose the other final point I'd just like to have clarification on, we're talking about effectively property companies here. Whether they be trading or investment, I suppose, is irrelevant to a point. But if those companies, those subordinate companies, are simply property owning companies, and they're SPVs, I suppose is the expression, isn't it?
Yeah.
What stamp duty rate applies if you make a transfer within that company? Is it the property stamp duty or is it the share stamp duty?
It depends on what you're transferring. If I'm transferring the shares...
But isn't that the same thing?
No, there's a difference between the asset I'm selling, i.e. property which sits on my balance sheet, that is due to standard stamp duty land tax, and the actual shares are stamp duty, funny enough, and stamp duty on shares is 0.5%. Very different. So the person buying it, if it's things, it can be a lot more beneficial potentially if you've done due diligence on the company. But very big if, I emphasize that. But then on the flip side, if you're actually selling the property, then it's down to conventional stamp duty depending on what that property's use is. And this can be a big hold.
All right, great. Thank you very much indeed. James, I have a large portfolio of buy-to-let property, and I've recently been hearing a lot about real estate investment trusts, i.e. REITs. Is this a tax-efficient way of holding a property and drawing a dividend? Please could the panel explain to me the basics of what a REIT is and the advantages of holding property in it?
Okay, sure. Well, let's just split out the question into two parts. Is it a tax-efficient way of holding property and drawing a dividend? Well, it's a wonderfully tax-efficient way of holding rental property, because if a company falls into the real estate investment trust regime, it specifically doesn't have to pay corporation tax on its profits. Brilliant. No tax avoidance scheme, government rubber stamp. But from a dividend perspective, you're not really any better off, because you'd pay tax on the dividend received. So really, where people get the most out of a REIT structure is where they have the company set up as a REIT and it can claim that status, but then looking very carefully at who the shareholder is, whether that's some type of pension scheme, it could be a SARS, it could be an overseas scheme, or you could use some of the things that Zee's been talking about, where you use a family investment company and just do further tax planning once the dividends are received.
Well, the query I have there is, you said, well, it doesn't pay any corporation tax. Okay, where does it pay its tax?
It doesn't, providing that the company itself that is in the real estate investment trust regime and it fulfills the conditions required by legislation. It specifically doesn't have to pay corporation tax, but there's a condition that the company does have to pay out 90% of its rental profits as a dividend on an annual basis. So there are strings attached to the corporation tax benefits.
So you're forced into taking a dividend, really, aren't you, which is taxable?
Yeah, absolutely. And
I'm sorry, I'm very simple on these.
No, of course, and that's where looking very carefully at how the shares are held,
right,
is important.
Okay, any comments there?
Yeah, if you look at REITs, and James has got huge knowledge on this, but for REITs generally, they have the exempt for corporation tax part and the non-exempt, and I think James highlighted some of the conditions around it. One of them is 75% ownership of a property rental business, i.e. the profits are coming from it. So that will be exempt for corporation tax, but the other part isn't exempt for corporation tax, and that can be one of the challenges. Also is, how do you take the money out, which James has highlighted fantastically well, is that when you take out the base, there's a withholding tax, something on income tax, if you are UK citizen and you take it out. Well, another good way, I think James probably mentioned as well, is ISAs can be a good way of holding the shares in there, because then they become tax efficient. So there's loads of different ways, but you need to map out your journey and make sure you've got the right people involved, that you make sure the investment in the REIT qualifies, you've got the right structure where you're getting the money for your own use, and then making it tax efficient, because there's different vehicles that can make it happen.
Okay, all right, well, we've had some fairly complex answers, so I'm going to ask you guys now just to in turn comment, if you wouldn't mind. We are certainly, whether we agree there's going to be a property crash or not, may be quite a difficult subject, and then identifying what kind of crash and to what level might be even harder. But I think there is an agreement on the point that we are heading for difficult times. And I'm just intrigued to know, as both of you being tax advisors, what are you advising your clients at the moment? Is it to batten down the hatches and be careful? Is it to say, well, there should be huge market opportunities here, go in and invest? Where are you? Start off with you, Zee.
I have a great question and a fantastic question in the current economic climate. It really depends on what the person's cash position is and also what deals are coming through. So the sourcing of deals is so important. Right now, I would expect a bit more margin of safety on the deals. Okay. So you would, if you're doing an investment or you're doing a development, say, you probably want 30-40% GDV. If you're doing investment, you're probably looking at the interest rate and your cash flow perspective and the loan to value. I think we touched on earlier episodes. I think these are key criteria to be looking at. And then what if the crash does happen the way people are potentially saying it's going to happen, if there's no government intervention?
I mean, looking in the short to medium term, interest rates are a factor to take into account when you're business planning, obviously. Mm-hmm. Where would you suggest somebody looks for a safe margin on interest rates at the moment?
I think I would, and I said this mentioned earlier, right now I'm probably looking 8 to 10%, because the reason being is if the base rate becomes like 5, 6, 7%, you've got to have so much value, and you've also got to think your loan to value. Historically, for residential, people have been basing it at 75%, and commercial 70%. You can get mortgages. Normally, in these kind of times, looking at the 2008 crisis, liquidity becomes an issue. So you've got to then start looking at about probably 50% or 60% as the ratio to give yourself a margin of safety. And a common thing is probably 50% loan to value is a comfortable bit if you have the funds available to do that.
Okay. And James, just for the last minute, what would you say on this?
Well, I'm going to agree with Zee on a very specific point, actually, that I think while not being an investment expert, stress testing anyone's models using interest rates of at least 8% is an absolute, you must be doing that, because otherwise the deal's probably not going to stack up. But just a question that I ask myself is, if we do have a complete meltdown, who's going to have the money to buy properties if they're repossessed? I think there's going to have to be a very pragmatic view taken by the institutions and the mortgage lenders about what they do with such properties.
I think, James, on that point, I think that's a huge opportunity. We've got a couple of minutes, because when repossessions happen, this is the time when people make their money. We've spoken to many entrepreneurs, and you've had many on the show. This is the time when they say is the best time, right? So if you've had robust business models, this is the time to invest and get your cash ready. As we mentioned, cash is king or queen depending who you're speaking to.
Oh, absolutely. And there are already people out there who are doing a good job to position themselves for this. There's a network of people that are looking to rescue people from repossession in a very ethical way, and we're just hoping that they're going to be able to help people out of whatever hole they might get themselves in.
Okay, gentlemen, thank you both very much indeed. That's all we've got time for in this show. So from Zee Razaq and James Hadley, thank you both very much for coming in and answering those questions. You did lose me on some of them, but I think we've got the gist of your advice anyway. Thank you both very much indeed. I'm Stephen Galpin. Join me again next time on Property Question Time.